Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about Canada. Bank of Canada paused interest rates. Does this mean that this is the end of rate hikes? And can we see now rate cuts come in? A lot of people out there are ecstatic and happy that, hey, finally they paused and that this might actually mean that they're done. Well, we did see Bank of Canada a couple months back pause rates just to go back to tightening again. And with Bank of Canada pausing rates, they did mention in their statement that they're continuing with QT, quantitative tightening. They're still going to continue to assess the situation globally, US, China, and within their own country to decide if whether they're going to hike or not. So this pause in September might be just a break to give, people, the break really, since a lot of people are upset with the rate hikes that have been happening in Canada, and especially with Canada's, and you look at certain markets like Toronto and Vancouver, the real estate market there that have blown up, and you see that how much of a bubble the prices are. A lot of people are pissed off and angry and are feeling the pain of these rate hikes. So could it be that just Bank of Canada decided that, hey, let's just assess the situation and give people kind of a breather, and then we will go back to raising rates? Now, I did mention in my previous video that I said that I could see Bank of Canada doing a rate hike in September. I admit I'm wrong, and I got that call wrong. However, I still see another rate hike coming out from the Bank of Canada, and I wouldn't be surprised that we get one in the next meeting. That's only on if nothing breaks by then. Now, if you look at Bank of Canada and the meeting they did the day after, they discussed that they see CPI heading back up again in the short term. And that's because oil prices have been going up. If you look at oil, crude oil in specific, it hit around $88 per barrel. If you look at Brent, it hit $90 per barrel. And that's definitely going to create the uptick in the inflation report. That's why Macklem, head of the Bank of Canada, came out and said that, hey, we could see the headline CPI move up. And that's why also in its meeting, Macklem said this over and over again, that we're not done. Our target is 2%. We're not going for any other target. We're not going for 3%. We're not going for 3.5%. We're not going for 2.9%. It's 2%. And you got to hit 2% and hit that for some time. And he said we got to see the evidence there in order that, we are seeing that inflation has hit our target. Now, although he did say that, we are close to achieving our goal, inflation has come down, so we're seeing progress. But also, the cost of all of that is, like you've probably heard of, in the last GDP report, you're seeing the contraction and the weakening in growth. And as that continues, and as these rate hikes, because there's a lag effect from all of these rate hikes that will be later seen in the economy, you will start to see growth continue to deteriorate. And if it really gets worse off, then that will basically mean that the Fed might be done there. But until then, we just got one GDP print. We got the jobs number recently. That number came in higher in Canada, and that caused the Canadian dollar to skyrocket because of the strong number. And on top of that, you got oil moving up higher, so it doesn't look like that they're done yet. So yes, they're going to continue with their QT, and I think they're going to still do another rate hike, and they're watching things and seeing how the effects of all the rate hikes they've done, how is this playing out in the economy? And so far, it's not that bad. So far, because of all the money printing that happened during COVID time, all of, the fiscal stimulus that are coming out from the government, you could argue that that's still keeping the economy afloat. So that means if economy continues to do good and it does well, then that means higher for longer. Another thing that Macklem mentioned as well is that rates may not go back to historic lows that we saw pre-COVID or during COVID levels, right? Macklem said that, hey, we might be in a new regime, in a new era where rates still are higher for longer. Now, I don't fully agree with that. I think we can see rates go back to COVID levels, go back to zero, especially if there's a hard landing, which I think is around the corner. It's just a matter of time. We don't know what is going to cause it, when is it going to happen. But if the economy and the growth and the data and the jobs really deteriorate, then yes, they will cut aggressively and even go far in cutting to the zero bound range. Now, a couple of other things Macklem has said, I'll just point out here. He said, we're prepared to raise rates again, but don't want to raise rates, then we have to. So again, like I said, still keeping somewhat of a hawkish tone there that we're prepared to do so. The longer we wait, the harder it is likely to reduce inflation. So, of course, they don't want to wait too long. They don't want to cut rates too early. They don't want to mess up there. They'll keep things tight, and they want to continue that until there's evidence, until there's strong signs that, hey, things are getting better. Might not be restrictive enough to restore price stability. Bank is concerned that larger than normal price increases for goods and services remain broad-based. We are not trying to kill the economic growth. However, yes, you're trying to engineer a recession. Okay, obviously they're not going to come out and say that, but if you look in history, every time there's a recession, you're able to get inflation coming to that 2% goal and that target. And what's also interesting is that Macklem and a lot of these G7 countries, the central banks, the head of the central banks there are meeting, I believe in Switzerland or Sweden or somewhere, to discuss about monetary policy within closed doors. So they're probably going to talk about, hey, why is this, inflation still up there? Why is it still not coming down? So definitely you can expect that Macklem is going to talk to other central banks or bankers around the world. And most importantly, who's the most important one out there? It's the US. It's the Federal Reserve, right? That controls the world reserve currency, the US dollar. And guess what? Macklem is going to look at what the Fed is doing, what Powell is doing, and mimic somewhat, similar to, the policy that the Fed is doing and implemented in Canada, right? So it's kind of like a wait and watch. Okay, what's data doing? What's the Fed doing? The Fed hiked again. Okay, we're going to hike too, right? So you could expect that later on. Again, unless something breaks and things get worse off, then of course you can definitely see the reverse where you get the cuts come in. Now, also, Macklem mentions, and a couple of points here, about 60% of CPI components are rising above 3%, and about 45% are rising above 5%. Looking ahead, we want to see less generalized price increases as well as a decline in the average price increase. The weakness in second quarter GDP largely reflected a broad-based slowing in consumer spending and a decline in housing activity. We will be watching wage growth slowly. So basically acknowledged the weak data, basically said that, hey, look, 60% of the CPI components are rising above 3%. That's not their 2% target. And 45% are above 5%. So inflation's still up there. They still need to get 2%. And Macklem reiterated and said that 2% is our target. We're not changing. 2%, 2%, 2%. So they will do anything to get to that 2%. That means creating the recession. That means, affecting the economy, the growth, the housing sector, jobs. All of this is going to be affected. Let me know what you guys think. Leave a comment below. Subscribe. Hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.